the day 150 countries got tariffed. Imagine waking up and finding out that your country's trade with the United States just got slapped with a new tariff. Not because of a specific dispute or a trade violation, but simply because you're on a list. That's exactly what happened when Washington announced it would impose tariffs on goods from 150 countries all at once. This wasn't a slow rollout or a targeted sanction. It was a giant, sweeping move, like someone building a massive wall overnight, blocking trade routes from every direction. Middle Eastern countries, especially in the Gulf, were stunned. In Riyadh, investors stared at their phones in disbelief. In Doha, a gas trader's hand trembled on the keyboard. In Cairo, a small business owner who'd just paid off his first loan was already wondering how he'd survive the next one. Because this wasn't just about taxes. It felt like economic war. The U.S. had thrown longtime allies, oil giants, logistics hubs, and gas suppliers, into the same basket as tiny microeconomies. The message from Washington was blunt. If you send more to us than we send to you, you're on the list. And so, Saudi oil, Qatari gas, Egyptian textiles, and Levant citrus were suddenly behind the same customs wall. The big question now, how will they respond? Let's take a closer look at what this means and what might happen next. President Trump's new tariff wall wasn't just a trade policy, it was a blunt instrument. Instead of negotiating with countries one by one, his administration put 150 nations behind a single customs line. Big or small, rich or poor, friend or rival, it didn't matter. If your country was sending more goods into the U.S. than it was buying in return, you got hit. On paper, this looks like a way to protect American workers. Tariffs, after all, are supposed to encourage local manufacturing and discourage cheap imports. But in reality, this plan had a different logic. Go after the countries with the least power to fight back. That meant smaller economies with little lobbying influence in Washington, or those with big trade surpluses, but no defense contracts or political leverage. That's where the plan gets strange. Countries like Saudi Arabia and Qatar, which are flush with oil money and closely tied to U.S. defense deals, were thrown in with tiny island nations and struggling African economies. The logic wasn't geographic or economic, it was political. Trump wasn't just targeting unfair trade, he was targeting low resistance. But here's the catch, the Gulf is not defenseless. These countries don't just ship goods, they control energy, logistics, and capital flows that America still depends on. And now, they're starting to look at retaliation options. Let's begin with the biggest one, Saudi Arabia's oil response. Saudi Arabia is one of the few countries that can shake global markets with a single decision. It pumps over 10 million barrels of oil per day, and even though it's building tourism cities and green energy projects under Vision 2030, oil is still its power card. Here's what's interesting. The U.S. didn't put a direct tariff on crude oil. That's because taxing oil imports could backfire badly, raising fuel prices at home and hurting American consumers. But there's a twist. The new tariff wall could still hurt Saudi oil indirectly. Saudi oil feeds into the chemical heart of Houston. It's not just gasoline. It's the raw material for plastics, polyethylene, and other petrochemical products. If the U.S. places high tariffs on plastic goods from small countries, American refineries may shift away from imported Saudi crude and lean more on cheaper domestic shale gas to produce these same chemicals. That shift could quietly reduce Saudi Arabia's daily oil exports to the U.S., which currently hover around 600,000 barrels a day. So how might Riyadh respond? Simple. Shift oil elsewhere. Start sending more barrels to China, India, and Europe. This isn't just about volume. It's about pricing. When Saudi supply to the U.S. drops, Brent crude prices rise. Even a $5 increase per barrel can mean 25 to 30 extra cents per gallon at the American pump. That's political dynamite during an election year. And in the Gulf, the phrase goes, the black gold from our soil heats the American stoves. So now Washington has a dilemma. Raise tariffs and protect domestic industries. Or keep oil flowing and avoid angry voters watching fuel prices climb. And that's just the beginning. Next up is Qatar, the king of natural gas, and it has its own move to play. So, Qatar may be small on the map, but it's actually a giant when it comes to natural gas. It's the world's top exporter of LNG, that's liquefied natural gas, powering homes, factories, and power plants from Tokyo all the way to Berlin. And, unlike oil which moves around in tankers and pipelines, LNG mostly depends on long-term contracts and price formulas. That gives Qatar a kind of leverage that, honestly, most people just overlook. Now, under Trump's new tariff wall, gas-rich countries like Qatar could face extra costs when they export energy-related products. The United States has built its own LNG infrastructure, and it really wants to compete with Qatar in Europe. So, at least on paper, tariffs could make American LNG look more competitive. But here's the thing, Qatar doesn't play by U.S. pricing rules. And that's exactly where it hits back. Instead of following U.S. gas hub prices, Qatar can just rewrite its export contracts. It can link them to Asian markets or, heck, even at a premium that ignores American supply altogether. The result? Well, higher prices in Europe. When Qatari gas gets pricier, there's less room for U.S. LNG to undercut. That means countries like Italy, France, and Spain, already struggling with energy inflation, start asking, why are we paying more for gas? Meanwhile, Washington engineers reading economic reports discover a pretty painful truth. Even thousands of miles away, a 40% tariff is just boomeranging back. Qatar doesn't need to embargo anything. It just rearranges its contracts, and suddenly U.S. LNG has fewer buyers, and European energy prices spike. The Gulf's message is clear. You want a tariff wall? Fine, but don't expect us to help you keep the lights on. Now, let's shift to a different kind of power, geography. Egypt doesn't export much oil or gas, but it controls something just as critical, the Suez Canal. Egypt's biggest bargaining chip isn't oil or gas, it's actually water. Specifically the Suez Canal, which is a 193-kilometer waterway connecting the Red Sea to the Mediterranean. It's easily one of the most important shipping routes in the world. If you're moving containers from Asia to Europe, or even from the Persian Gulf to the U.S. East Coast, you probably go right through Suez. Now, Trump's tariff wall might slap Egyptian textiles and citrus exports with a pretty hefty tax. But Egypt isn't looking to fight back with goods. Instead, it can weaponize logistics. So, just imagine this. Cairo announces a 15% toll increase on any ship carrying cargo bound for the United States. It might not sound like a huge deal, but that cost trickles right down the supply chain. It means higher fuel bills, longer delivery times, and price hikes at distribution centers in places like New Jersey or Georgia. And when those costs eventually get passed on, well, American consumers feel it. A $1 hike in canal fees can easily become $2 more at a retail shelf. Cairo can just say, we're just balancing our books. But Washington knows it's a message. The U.S. sees the Suez as a neutral highway. Egypt, though, sees it as a national asset. And if tariffs squeeze Egypt's economy, the canal becomes its way of pushing back. And that's not just theory. The Suez brings in about $9 billion a year, a vital stream for Egypt's pretty fragile budget. If textile factories close or fuel prices spike, Egypt needs to make up the difference somewhere. And that somewhere could be right in the middle of global trade. In short, Cairo's retaliation isn't with paperwork, it's with waterway pricing. A quiet toll shift in Suez could echo all the way to Norfolk's shipping yards or Los Angeles's warehouses. But while Egypt plays its canal card, another country in the region faces a very different kind of threat. Not economic, but financial survival. Let's talk about Lebanon. Lebanon is not a major exporter to the United States. It doesn't sell barrels of oil or ship containers full of gas. Its citrus, fish, and timber exports barely register on U.S. trade stats. So why does Trump's tariff wall matter here? Well, because Lebanon runs on dollars, not exports. Its economy is fragile, teetering from one crisis to the next. What keeps it afloat are two invisible forces: U.S. dollar remittances from its global diaspora and financial aid from Gulf states. If Washington decides to weaponize tariffs not just on goods but also on financial services, by restricting dollar flows, imposing extra scrutiny on Lebanese banks, or adding compliance hurdles, then Beirut's already shaky banking system could collapse. This isn't just economic pain, it's a political risk. In Lebanon, where political factions balance on a razor's edge, economic shocks often turn into street protests, government collapses, or worse. So if Lebanese families can't access dollars sent by relatives in Detroit or Dubai, the impact is immediate and honestly pretty emotional. Yet Washington's message remains, this is economic, don't politicize it. But in the Levant, everything is political. A small squeeze in one area, banking, tariffs, remittances, can cause a big blow-up somewhere else. The danger here isn't retaliation like with oil or tolls. It's that desperation leads to instability, and instability in Lebanon has a long history of spiraling. Trump's trade wall may claim to be about economics, but in Beirut, it's seen as a political wall. one that could shut the door on the country's last remaining financial lifelines. Now let's zoom out. Because while these countries may react individually, the real threat to Washington comes when their responses start to overlap and stack up. Each country's retaliation, whether it's Saudi oil shifts, Qatari gas pricing, Egyptian toll hikes, or Lebanon's financial fallout, might seem manageable on its own. But when they all start happening at the same time, something more dangerous takes shape. Strategic blowback. Let's connect the dots. Saudi Arabia slows oil exports to the U.S., raising Brent crude prices. Qatar rewrites gas contracts, pushing European prices higher and making U.S. LNG less competitive. Egypt hikes Suez Canal tolls, increasing delivery costs and squeezing U.S. retail supply chains. And Lebanese banks struggle to access dollars, creating a ripple of instability across the Levant. But it doesn't stop there. These economic moves begin to interfere with U.S. defense and financial systems. For example, Saudi Arabia hints it could replace U.S. Patriot missile systems with Korean or Israeli alternatives. Qatar and Egypt start discussing yuan-based payments for LNG or Suez tolls. Gulf states begin diversifying away from the U.S. dollar, using China's CIPS payment system instead of SWIFT. The petrodollar cycle slows down, weakening demand for U.S. Treasury bonds. And in Washington, lobbyists begin to worry. Boeing, Raytheon, and Midwest farmers see contracts threatened. Treasury officials see the dollar index wobble. The Fed feels pressure to tighten interest rates just to maintain capital flow. In short, Trump's tariff wall was built to protect. But retaliation from the Gulf starts to hit the exact pillars it was meant to strengthen: energy stability, military alliances, and the strength of the dollar. And that brings us to the final and perhaps most critical question. What happens if the wall stays up, or even comes down too late? Here's the irony. Even if Trump's tariff wall collapses tomorrow, the damage might already be done. Because global trade isn't static, it adapts. Once Qatar starts pricing LNG in euros or yuan, once Saudi shifts oil shipments to Beijing, once Egypt adjusts Suez tolls for US-bound cargo, new trade patterns begin to settle in. They don't just disappear if the wall falls, they become the new normal. That's the true cost of the tariff blitz. It forced the Gulf to innovate. Instead of fighting Washington head-on, these countries simply rerouted the flow. Petrodollars became petro-yuan. Western banking channels gave way to Asian ones. Suez fees became a geopolitical dial, and U.S. energy exports lost their shine in Europe. And the U.S.? It may win a few headlines, protect some short-term jobs, and claim victory at the ballot box. But underneath, its grip on global finance, trade, and influence starts to loosen. Even America's defense industry isn't safe. If the Gulf stops buying U.S. jets, cancels upgrades, or questions alliance stability, the Senate isn't going to blame Doha. It'll look straight at Washington. So what's the takeaway? In geopolitics, walls don't hold back capital. Oil flows, gas contracts, container ships, and remittances. These are long-legged forces. They jump over barriers and build new bridges. And once they do, they leave behind broken bricks. The investor in Riyadh who spilled his coffee that morning, he didn't panic. He looked out the window and smiled. Because in the Gulf, crisis doesn't mean collapse. It means opportunity, reprised. And in this new chess game, the Gulf isn't flipping the board. It's making long moves, patiently, powerfully, fueled by oil, LNG, and the toll lanes of the Suez. What do you think? Is Gulf retaliation just beginning, or is it already shaping the future of global trade? Leave your thoughts in the comments. And if you enjoyed this analysis, don't forget to like, subscribe, and turn on notifications so you never miss a story that connects money, power, and the world. Thanks for watching.